The average American will earn over $2 million during their lifetime, yet most people retire with less than $100,000 in savings. It is easy to blame that gap on daily spending habits or a few badly timed market crashes, but the data reveals a different story. Most of that wealth is lost because of internal shifts that happen at very specific milestones. Building wealth is not a linear climb, where saving $10,000 always feels like $10,000. There are specific numerical tripwires, specifically at the $250,000 mark, where the way you perceive every dollar starts to change. At this level, your money begins moving faster than you do. A single afternoon of market movement can generate more profit than your weekly paycheck, making the wealth finally feel like a tangible reality rather than a theoretical goal. This chart shows the shift in stakes. On a $5,000 portfolio, a 10% market drop costs you $500. It's an annoyance. But at $250,000, that same 10% dip rips a $25,000 chunk out of your net worth, an amount larger than what most people save in an entire year. This is a uniquely dangerous middle ground. You have enough capital to make errors that cost years of progress, but you lack the massive scale required to absorb those losses and recover quickly. When you see your digital balance jump by several $1,000s in a single morning, it is easy to feel like you've already reached the finish line. You start calculating your gains and convinced that you are finally officially wealthy. This leads to a common translation error, treating an unrealized digital gain as if it's realized cash. You see an $8,000 paper profit on Tuesday, and by Wednesday, you're looking at $10,000 luxury vacations. After years of steady growth and navigating a few minor market dips, it's natural to assume your success is the result of superior intuition. You stop crediting the market's rising tide and start crediting your own genius. This confidence often leads to a sudden pivot. Investors who spent years buying broad, boring index funds suddenly decide they are ready to pick individual stocks, trade complex options, or move their core savings into speculative, volatile assets. They begin to rationalize high-risk moves by telling themselves, I can afford to lose this. But having the capacity to absorb a loss is not the same as having a reason to invite one. The irony is that the same discipline and delayed gratification required to reach $250,000 often creates the very hubris that ends up destroying it. Even for the disciplined, external pressure can be corrosive. The pride of hitting $250,000 can vanish instantly the moment you encounter a peer or a social media post showcasing a seven-figure portfolio. Suddenly, your progress feels like a failure. You feel an urgent need to catch up, often leading you to abandon the slow, steady strategy that got you here in favor of something much more aggressive. This desperation often drives investors to take on debt, leveraging their existing foundation to try and force a higher return. You're no longer just investing what you have, you're gambling with what you've already won. The math of borrowing at 6% to chase a 10% return sounds logical until the market corrects. Leverage turns a standard, temporary market dip into a permanent financial catastrophe that can wipe out years of savings. The desire to match someone else's timeline frequently forces investors to discard the boring, fundamental strategies that actually built their wealth in the first place. To navigate this threshold, you have to look past your own impulses and look strictly at the mathematical reality of how time impacts your money. At an 8% return, it takes 13.8 years to reach your first $250,000. But if you stay the course, it takes that exact same amount of time to reach $1 million. The same time for 3 times the wealth. This is why an early mistake is so costly. Every $10,000 lost today to a bad trade or an impulsive purchase is actually $40,000 in future wealth being deleted from your retirement. This compounding effect is why Charlie Munger famously emphasized that the first $100,000 is the hardest. At $250,000, that momentum is finally working in your favor. Survival at this level requires unlearning the need to be clever. You have to ignore the impulse to optimize and instead commit to the same boring, repetitive actions that got you here. Building a $1 million portfolio requires the discipline to get out of the way and let the math finish the work it has already started. This data visualization shows a glaring contradiction in modern personal finance. The average American will earn over $2 million during their working lifetime, yet somehow most people retire with less than $100,000 in savings. That leaves an enormous question. Where does all that money actually go? We're conditioned to believe that building wealth is a linear equation. You save $10,000, you are $10,000 richer. It feels like simple math, where your bank account scales perfectly alongside your physical effort. But that massive drain of lifetime wealth isn't primarily caused by everyday spending habits or sudden market crashes. It comes from deeply ingrained psychological traps that kick in at specific wealth levels. Treating wealth like a straight line leaves us exposed to the psychological shift that happens when the money starts moving faster than the person earning it. There is a precise financial milestone where that linear thinking suddenly breaks down. That number is $250,000. Reaching $250,000 in investments triggers a distinct shift inside your head. It is the exact moment your wealth transitions from being a theoretical number on a spreadsheet to feeling dangerously real. This specific amount acts as a trap rather than a safe harbor for a very specific reason. You finally have enough money to make life-ruining financial mistakes, but you do not have enough wealth to recover from them quickly. Consider how a standard 10% market correction hits differently. When you have $5,000 invested, a 10% drop costs you $500. It's annoying, but entirely manageable. But when you have $250,000 invested, that exact same percentage drop tears away $25,000. That is more than the median American's entire annual savings. The $250,000 threshold marks the entry into a high-stakes environment where one wrong move deletes years of progress. The structural mechanics of money actually shift at $250,000. This is the exact point where your money begins moving faster and working harder than you physically can. This chart shows how compounding math plays out. If you have a $250,000 portfolio earning a standard 8% annual return, your money automatically generates $20,000 in passive growth every single year without you lifting a finger. And the daily volatility at this scale is just as jarring. One exceptional day in the market can generate an $8,000 spike. That is a single day out-earning what a typical monthly paycheck brings in. This collision between manual saving and passive momentum creates a specific psychological tension. Because we are used to being the primary driver of our growth, seeing the portfolio move faster than we can work triggers a reflexive and often destructive urge to interfere. This urge to interfere manifests in 3 specific behavioral traps. The first is the illusion of arrival. Seeing thousands of dollars in unrealized digital gains tricks your brain into feeling rich. You start believing you deserve a reward, prompting you to spend fake on-paper money on permanent liabilities, like a $10,000 luxury vacation. The second trap is the overconfidence monster. After you've survived a few market cycles and watched your balance grow to $250,000, the Dunning-Kruger effect kicks in. You start to believe you possess some kind of unique investing genius. This is the moment otherwise boring, successful index fund investors go completely off the rails. They abandon their steady approach and start pouring money into speculative individual stocks, risky cryptocurrency bets, or a friend's private business venture. A $10,000 loss at this stage deletes $40,000 of future wealth, as that principal no longer exists to compound over the next 2 decades. The third and most insidious trap is the comparison trap, which breeds a very specific condition called acceleration anxiety. You feel pretty good about your $250,000 until you meet someone at a networking event with a $1 or $2 million portfolio. Suddenly, you feel behind. This triggers desperate behaviors, like leveraging your portfolio or taking out home equity loans to invest, just to violently force the math to close the gap. All 3 of these traps share the exact same fatal flaw. They happen because an individual hits a major milestone and confuses having financial options with having unlimited invincibility. There is one final mathematical misconception that destroys portfolios at this level: the assumption that having $250,000 means you are exactly 1/4 of the way to becoming a millionaire. This timeline illustrates compounding wealth. Investing $10,000 annually at 8%, the brutal climb to $250,000 takes 13.8 years. But because of momentum, reaching a full million takes the exact same time, covering 3 times the ground. This grueling reality of early wealth building is exactly what the late Charlie Munger was referring to when he famously warned that the first major financial milestone is always the hardest. In terms of time, the $250,000 mark represents the halfway point to millionaire status. The money has finally built enough speed to roll downhill without you constantly pushing the boulder. We need to reframe what this $250,000 actually exists for. It does not exist to fund an amateur day trading habit or to justify luxury purchases. It exists to buy you raw, unadulterated life options. It gives you tremendous career leverage. You now have the financial cushion to take a calculated pay cut for startup equity, negotiate fearlessly with your current employer, or relocate across the country for a massive opportunity. To survive this phase and reach $1 million, you need to cultivate an incredibly difficult discipline. You need the ability to sit still, ignore the noise, and remain completely, utterly boring. Navigating this threshold requires unlearning the instinct to be clever. Success at this level depends on the ability to ignore new opportunities and stick to the boring strategy that actually works. Your money has reached escape velocity. The hardest part wasn't getting here. The hardest part is having the discipline to step back, do nothing, and let inevitable wealth build itself.